Is your money safe in the bank? With rising inflation, holding cash is a losing strategy. For middle-aged Americans focused on retirement, the goal is stability and growth, something banks can't offer. This video explores 5 investments that are safer than cash, designed to protect your assets while generating steady returns. Learn the strategies smart people are using right now to build sustainable long-term wealth for their future. 1. U.S. government bonds. In an era of rising inflation and market volatility, the long-held belief that cash is the safest asset is being challenged. For middle-aged individuals focused on protecting a lifetime of savings, holding money in a traditional bank account means watching its purchasing power quietly erode. Consequently, U.S. government bonds have re-emerged as a cornerstone of prudent financial planning, offering a secure and effective alternative for capital preservation. At their core, government bonds are debt instruments issued by the U.S. Treasury. When you buy a bond, you are lending money to the government, which in return guarantees regular interest payments and the return of your principal at maturity. Their most compelling attribute is their unparalleled safety. Backed by the full faith and credit of the U.S. government, the risk of default is virtually non-existent. This stability provides a critical financial shield, especially for those nearing retirement who cannot afford to risk their capital in volatile markets. Strategically, government bonds serve as a defensive anchor in a well-diversified portfolio. They counterbalance the inherent risk of growth-oriented assets like stocks and ETFs, minimizing overall volatility and protecting against severe downturns. A sophisticated strategy known as bond laddering, investing in bonds with staggered maturities, further optimizes this approach. It allows investors to benefit from varying interest rates while ensuring that a portion of their capital is always becoming available, blending stability with access. While not a get-rich-quick scheme, U.S. government bonds offer something far more valuable for the long-term investor: peace of mind. They are not merely a financial product, but a strategic tool for building a resilient financial future. By shifting focus from high-risk speculation to disciplined preservation, investors can ensure the wealth they have spent decades building is secure, enabling them to retire with confidence and stability. 2. Dividend-paying ETFs. In an increasingly complex financial world, middle-aged Americans are searching for investment options that are not only safe, but also simple, effective, and capable of generating steady passive income. Dividend-paying ETFs fit that bill perfectly. They protect your wealth, deliver consistent returns, and don't require you to monitor the market day in and day out. ETFs, or exchange-traded funds, are portfolios that invest in a group of stocks or specific assets. Dividend ETFs, in particular, focus on companies with a long-standing history of stable and consistent dividend payments. Familiar names like Coca-Cola, Johnson & Johnson, and Procter & Gamble often appear in these funds. They're companies with strong financial foundations, sustainable business models, and a solid track record of sharing profits with shareholders. The most notable advantage of dividend ETFs is their unique combination of regular income and long-term capital growth. When you invest in a dividend ETF, you receive quarterly dividend payments, either as cash or automatically reinvested into the fund. This passive income stream is especially valuable if you're aiming for financial stability or preparing for retirement. On top of that, you still benefit from potential share price appreciation over time, allowing your investment to grow steadily. Unlike individual stocks, dividend ETFs offer built-in diversification with a single purchase. Instead of betting on a single company, you're spreading your risk across dozens of high-performing businesses, reducing the likelihood of heavy losses from one stock's sudden drop. This level of stability and lower risk is particularly suited for middle-aged investors, those who seek consistency, safety, and still want to optimize long-term returns. One of the biggest benefits? You don't need to follow the market every day.
These ETFs are typically passively managed, meaning their portfolios track major dividend-focused indexes like the S&P 500 Dividend Aristocrats or the Dow Jones U.S. Dividend 100. This hands-off approach saves time, reduces the stress of constant decision-making, and still allows your investments to grow in line with the broader U.S. economy. In today's environment of persistent inflation and rising living costs, holding cash in the bank is becoming an increasingly ineffective strategy. Dividend ETFs, on the other hand, help you fight inflation by generating a steady income stream while your original investment continues to grow. This is exactly what smart Americans are doing. Instead of letting money sit idle, they're turning it into a working stream of cash flow. What makes this strategy even more powerful is dividend reinvestment, using your payouts to purchase more shares of the ETF. This takes full advantage of compound interest, where your profits begin to earn profits of their own. Over time, your investment can grow significantly without needing additional capital, especially if you start early and maintain a long-term financial vision. ETFs are not only easy to access, but also come with lower management fees than traditional mutual funds, saving you substantial money over the long run. And since they trade like regular stocks on the open market, buying and selling ETFs is incredibly flexible, with real-time pricing and liquidity at your fingertips. In a volatile market, dividend-paying ETFs provide a smart, efficient investment path. You don't need to be a financial expert to use them. With a clear strategy, consistent investing, reinvesting dividends, and disciplined money management, you can build a stable, growing portfolio that supports your financial goals for years to come. To sum it up, if you're looking for an investment option safer than cash, capable of producing passive income, and not overly demanding in terms of time or financial expertise, dividend ETFs are an ideal choice. They don't just keep your assets secure, they quietly build your wealth quarter after quarter, year after year, without requiring constant market watching. It's a strategy that many smart middle-aged Americans are embracing to prepare for a more secure and financially independent future.
Everything. 3. Real estate investment trusts. When most people think of real estate investing, they picture buying a home, managing tenants, and dealing with leaky pipes or endless maintenance calls. But for middle-aged Americans who value financial stability and have little time for the headaches of property management, there's a smarter way to access the real estate market without ever owning or managing a single property. Enter REITs, Real Estate Investment Trusts. REITs are companies that invest in income-producing real estate. Their portfolios often include shopping centers, office buildings, luxury apartment complexes, hotels, hospitals, and even data centers. Instead of purchasing a home yourself, you simply buy shares in a REIT. And by law, these companies must distribute at least 90% of their rental and operating income to shareholders in the form of dividends. The biggest advantage of REIT is accessibility. Instead of needing hundreds of thousands of dollars to buy a property, you can get started with just a few hundred and still benefit from rental income and property appreciation over time. For people in their 40s to 60s, this is a powerful way to gain exposure to hard assets like real estate without the financial burden or management risks of owning property directly. Unlike owning a home, investing through REITs doesn't mean dealing with tenants, fixing plumbing, or worrying every time the housing market takes a dip. These real estate portfolios are managed by experienced professionals whose sole job is to operate and optimize these assets to deliver returns. That means peace of mind for you. You invest, collect dividends, and skip the stress of being a landlord. Beyond the steady cash flow, REITs offer something traditional real estate doesn't: liquidity. Instead of waiting weeks or months and paying hefty fees to sell a house, REIT shares can be bought or sold instantly on public exchanges, just like stocks. This flexibility is crucial for middle-aged investors, especially when access to cash in an emergency matters. Strategically, REITs are also an effective way to diversify your investment portfolio.
When the stock market is volatile or inflation is rising, real estate tends to retain its value better than many other assets. REITs help balance your risk so you're not overly dependent on the performance of stocks or bonds. That's a core financial principle, especially as you near retirement. Some REITs even specialize in high-growth sectors like senior living facilities, e-commerce warehouses, or data centers, real estate segments with long-term potential in today's evolving economy. What was once exclusive to large institutional investors is now accessible to everyone. With inflation remaining a long-term concern and the cost of living steadily climbing, REITs have become a compelling alternative to holding cash. They generate regular income, preserve long-term asset value, and eliminate the need for hands-on property management, complex tax filings, or costly repairs. You get all the benefits of real estate ownership without the burdens of being a landlord. If you're looking for a safer, income-generating, and liquid investment alternative to cash, REITs deserve serious consideration. They're not just an investment vehicle, they're a strategic way for middle-aged Americans to protect their assets, grow their capital, and prepare for a more secure financial future without sacrificing time or energy.
4. Index funds. By the time most Americans reach middle age, their investment mindset shifts. It's no longer about chasing quick wins or risky ventures. It's about protecting and growing wealth in a stable, sustainable way without needing to micromanage every dollar. That's exactly why index funds have become one of the most trusted, time-tested investment vehicles, used by the wealthy, endorsed by financial experts, and perfectly suited for anyone aiming to build a long-term, worry-free financial future. An index fund is a passive investment vehicle that mirrors the performance of major stock market indexes like the S&P 500, Dow Jones, or NASDAQ. Instead of trying to beat the market, these funds aim to track the market. Take the S&P 500, for example. This index represents 500 of the largest, most stable companies in America, including household names like Apple, Microsoft, ExxonMobil, and Johnson & Johnson. What is the biggest advantage of index funds? Broad diversification with minimal risk. When you invest in an S&P 500 index fund, you're not betting on a single company. You're investing in the collective performance of 500 industry leaders. If one or two underperform, the others help balance it out. This "don't put all your eggs in one basket" approach is a fundamental principle of smart, long-term investing. Another key benefit is exceptionally low fees. Because index funds are passively managed, meaning there's no expensive team trying to pick and time stocks, they carry extremely low expense ratios, often between 0.03% and 0.10% annually. Compared to actively managed mutual funds or traditional financial advisors, this means more of your money stays invested and working for you. Over decades, that fee difference can mean tens of thousands of dollars more in your pocket, especially critical when planning for retirement. And here's what's surprising to many. Index funds often outperform the majority of actively managed funds over the long haul. Study after study has shown that most professional fund managers fail to beat the S&P 500 over 10, 15, or 20-year periods. That's why legendary investor Warren Buffett has repeatedly advised that the best investment most people can make is in a low-cost S&P 500 index fund and to simply hold it long-term. Index funds also make investing refreshingly simple and stress-free. You don't need to follow financial news daily, analyze stock charts, or constantly switch strategies. You just invest regularly, stay disciplined, and let the market's long-term growth do the work. Historically, the U.S. stock market has proven its ability to recover from every crisis, making it a reliable foundation for wealth building. Want to supercharge results? Reinvest your dividends.
By automatically using the payouts from your index fund to buy more shares, you tap into the power of compound growth, where your earnings generate their own earnings. This snowball effect is how ordinary investors can quietly build extraordinary wealth over time without increasing their monthly contributions. And if you ever need access to your money, no problem. Index funds are highly liquid. You can buy or sell them just like individual stocks, quickly and transparently. This flexibility gives you peace of mind, knowing your money is growing without being locked away. In a world where cash is constantly losing value due to inflation, index funds offer a smarter alternative. They help you protect purchasing power, grow your savings, and do it all with minimal risk, time, and effort. For anyone in midlife looking to build a rock-solid foundation for retirement or simply want their money to quietly work harder, index funds deliver exactly that. If you're seeking an investment strategy that's safer than cash, cost-effective, hands-off, and historically reliable, index funds are your best bet. Backed by the strength of the U.S. economy and the performance of America's top companies, they let your money work quietly and efficiently, year after year.
5. Roth IRA. When it comes to preparing for a secure and comfortable retirement, one of the most overlooked yet most powerful factors is how your investment gains are taxed. You could be a disciplined saver and a smart investor, but if taxes eat into your earnings every step of the way, your long-term results may fall short. That's exactly why the Roth IRA has become a cornerstone strategy for millions of Americans pursuing financial freedom. A Roth IRA is a retirement account funded with after-tax dollars. That means you contribute money you've already paid taxes on. But here's the key advantage. Every dollar of growth, whether from stocks, bonds, ETFs, or index funds, is 100% tax-free when withdrawn in retirement, as long as you meet the age, 59.5, and 5-year holding requirements. Compare that to traditional 401k plans, where taxes are simply deferred. You'll eventually pay income tax on every dollar you withdraw. The true power of a Roth IRA lies in shielding your future gains from taxes. If you're currently in a moderate tax bracket but expect your income or national tax rates to rise over time, a Roth IRA ensures that your investment growth stays untouched. Every cent you earn inside the account is yours to keep. Unlike employer-sponsored retirement plans, Roth IRAs offer full control over your portfolio. You can invest in individual stocks, bonds, dividend-paying ETFs, S&P 500 index funds, and more, tailored to your own strategy and risk tolerance. That level of flexibility is rare in retirement accounts like 401ks, and it empowers you to be intentional and strategic about your financial future. Another major perk? No required minimum distributions, or RMDs. While traditional IRAs and 401ks force you to start withdrawing and paying taxes at age 73, Roth IRAs don't. You can let your money grow tax-free for life, or even pass it down to your heirs. This makes Roth IRAs an ideal vehicle, not just for retirement income, but for legacy planning as well. A Roth IRA also serves as a secret weapon against inflation. As the cost of living rises, having an account that maximizes the power of compound growth, tax-free, becomes even more critical. Every dollar reinvested in your Roth IRA can grow to its fullest potential without being chipped away by annual tax deductions. In 2025, contribution limits stand at $7,000 per year, or $8,000 if you're age 50 or older. This encourages consistent, long-term saving. While there are income limits for direct contributions, savvy investors are using the backdoor Roth IRA strategy to legally convert traditional IRA funds into Roth accounts, unlocking tax-free growth regardless of income. If you're 35 or older and starting to take your financial future seriously, the Roth IRA is a tool you can't afford to ignore. It offers tax protection, growth potential, investment flexibility, and long-term peace of mind, all in one powerful package. It's more than just an account. It's a smart move in a world where tax laws, markets, and inflation are constantly changing. Stop letting your cash lose value.
The path to a truly free retirement lies in growth assets like REITs and Roth IRAs, not savings accounts. This is how you build a stable foundation with passive income. If you're ready to protect your wealth and build for the future, like, subscribe, and share this video. Let's start building generational freedom today. See you in the next video.